Hey everybody, welcome to the free video. I want to talk about a trade that we put on today that I think is a fairly safe trade in an environment like this, and also has the potential for a nice potential reward for not a lot of risk. So I had a couple of questions starting off on Amazon, and if you're going to trade Amazon, of course you want to take into account what? There's a lot of earnings coming up, right? And the options on Amazon right now are super pricey. The implied volatility rise is, even making out of the money Delta 30 options like $40, right? So it can be a little tough sometimes for people to play that, and you can't do spreads for earnings, going into earnings, because that implied volatility is going to hurt that option that you sold. So then we kind of come back and say, all right, well, what are the Qs doing in this environment? And if we take a look at the QQQ, you can see it's like, all right, we're in a situation right now where we do have kind of a nice little wedge here, that's a nice little uptrend that's been forming. We took out the downtrend line, so we have some potential for some more short covering next week. But as we know, this market has been a little jumpy. And so when I look at this as a market that could explode higher in a bout of short covering or implode lower in another round of kind of forced selling and margin calls. The main thing I don't see here is this market being quiet and trading sideways, okay? So if I dig down a little deeper and look at XLK, which is of course the ETF that focuses on the technology sector, the same thing applies here. So what kind of trade do you do in a situation like this? So what we did is we looked at the May monthly straddles and strangles on this trade. Okay, oops, it didn't write out there. But what's nice about this is that, the way this trade doesn't work is if suddenly between now and at the end of monthly expiration, this does not do anything. Okay, that's the worst thing that could happen. But the idea that we have unknown volatility and are not completely sure if this thing's going to explode higher in short covering or implode lower makes this an ideal candidate for long strangles and long straddles because of a couple things. ETFs have pretty low IV when compared to a lot of other stocks. Okay, that's the first thing. Secondly, ETFs have very narrow spreads, which is great, and the liquidity is also solid. Okay, so three things there too. It makes it very unique for this kind of a trade. So what does it look like? So from a risk parameter, what happens is, so we did the $66 strangle. So that means we bought the $66 call and then the $66 put, and it was like $3.50. Okay, so what that looks like essentially then is that you're going to have your, here's the price that you got it, and essentially if it does nothing, that's where kind of your max loss comes in. All right, so if it does nothing, then you're going to lose, and if you held it to expiration and it closed exactly at 66, then you'd lose that entire $3.50. Okay, but of course, we aren't looking to hold into a potential max loss position. However, from there, if it can go over 66.50 to the upside, or sorry, 67.75 to the upside, okay, or anything over like a similar to the downside, anything above that is profit. So what you're looking for is that, okay, in this range here, you could make a little, lose a little, but you're looking for either an explosion, essentially to the upside, or an implosion to the downside, and then you're actually starting to make a lot of money. All right, so it's a really awesome trade in this environment, and they've been working great. So if you are unsure about straddles and strangles, Bruce and I are going to be holding a free webinar on these on Tuesday, April 17th. It's going to start at 7 o'clock Central. I learned most of the stuff from Bruce. So we do them a little bit differently, but I found kind of in listening to him ways to pinpoint some shorter, more active situations to utilize these tools. But essentially, he did these at a $100 million fund for over 20 years. So what he calls this is simpler straddles and strangles, how to safely extract big gains from volatility, which is exactly what they do. So during this, we're going to talk about a couple different things. Specifically, Bruce is going to cover a case study about a $125,000 SPX straddle that caught the February crash, when to use straddles to catch lightning in a bottle opportunities, extracting max gains from wild price swings swings without getting wrecked. This is the great thing, is when you have so if you're directional, right, and let's say you're directional long, and especially in this environment, you wake up and the S&Ps are down, 40 points. It's like, oh my God, this is going to be a long day. Or if you're short and you wake up and they're up 30 points, you're like, oh my gosh, this is going to be a long day. When you have a straddle or a strangle, you don't stress that at all. You don't care as long as there's big, violent movement, okay? And in fact, if it's back and forth like that, that's even better, as we'll talk about different ways to play that. And then 2 rookie mistakes that you should avoid like the plague. So again, free webinar Tuesday, April 17th, 7 o'clock Central, and we will see you there.